Are you ready to take control of your financial future? Barry Watts with WealthCare has the strategies you need to plan for a successful retirement. Whether you're planning for retirement, saving to live out your dreams, or looking to grow your wealth, Barry has resources to guide you every step of the way. Barry and the team at WealthCare develop customized plans to help you achieve your financial goals. Welcome to Watts on Wealth with Barry Watts.
In life, there are many things you can't control. The good news is there are some things you can control, and that does include how much we'll all pay in taxes. On our show, Watts on Wealth today, you'll learn how to keep more of your hard-earned money, giving less to old Uncle Sam. Later on in our show, we'll answer some of your big retirement questions as we welcome in the main retirement designer for the WealthCare Corporation, Barry Watts. Barry, it's always great to see you.
Thank you. I'm excited to be here, Ralph, because we're going to talk about one of my favorite topics today, taxes.
Taxes is one of your favorite things?
Well, here's why. It's an area where I can really help people and move the needle profoundly, and most people don't know that. They don't have any idea how they can save in taxes. That's what we specialize at the WealthCare Corporation, and that's why I'm so excited about today's show.
Well, that's great. Let's get on with it. Well, control, we all like to have control. There are so many things we cannot control: the weather, the stock market, that traffic jam maybe along Glenstone you run into on your way to work, things regarding your spouse. Many of us think when it comes to retirement, we have no control over how much we'll pay in taxes. Barry, you say that's not entirely true.
Well, you do have control over how much you pay in taxes, particularly in the years prior to retiring. If you'll make some critical decisions, it can save you hundreds of thousands of dollars over your retirement years. And yet each year in Southwest Missouri, people pay hundreds of thousands of dollars more in taxes, I should say hundreds of millions of dollars more collectively, that they don't have to pay. But they pay them because they don't know that they have options. They don't know that there are other ways to look at the tax code. They don't know that the IRS is not necessarily something to be feared. If you have the right kind of representation and people planning for you, you can save a lot of money in taxes that'll make a tremendous difference for you and your family.
I've mentioned on our radio show the word theirs is spelled the IRS.
Yes, it is.
It comes out as theirs. We want it to be ours.
That's exactly
That's
the
how
whole point to what we're going to talk about today.
Well, how big of an impact can taxes have on retirement? Is it one of our biggest expenses?
Actually, it's your number one expense in retirement. People don't expect that. And you know, the thing about taxes is they're insidious. They just come in and bite at a time. This year's tax and this year's tax and next year's tax. And people don't realize how big that tax bite is over time. So Ralph, the first thing to understand is that most people, when they get to retirement, have never done any kind of tax planning. They don't have any form of tax strategy in retirement. In fact, they didn't even know that it was important to have one because they didn't know that they had any control. Now, they may have a CPA who completes their tax return, and he or she is what we call a tax compliance person. They make sure you're in compliance with the IRS. They keep track of what happened historically and record it on the proper government forms. But in order to save money in taxes, you have to be proactive. You have to have a tax strategy that is forward-looking instead of like looking in the rearview mirror. I like to say that CPAs look in the rearview mirror and tax strategists look through the front windshield at what's coming up so we can make adjustments to what is reported to the IRS. And that is done using the favorable rules in the tax code, rules that CPAs generally don't get educated on. Those of us who are educated by the IRS do know about those rules, and we're able to save people a lot in extra tax money. So that's one of the things that we do at the WealthCare Corporation that's a little different, and it helps our clients pay less taxes in retirement, and some of our clients actually get to a position where they are 100% tax-free.
Really?
That's the exciting news. Yes, in the 0% tax bracket in retirement. Not everybody can get there. But if you can't get to the 0% bracket, let's get you to the lowest bracket possible. And for everybody, that's a tax savings.
Yeah. I love that comparison of looking through the windshield and looking through the rearview mirror on where we are on taxes. Barry, can you talk more about some ways we can control our tax situation where we don't downgrade the lifestyle we want in retirement?
Well, Ralph, the important thing to realize is if you've got $1 million in your IRA account and you feel pretty good about that, I've got $1 million, you don't really have $1 million in your IRA. You've got about, $650,000. And Uncle Sam has about $350,000 that he's just storing in your IRA account and letting you feel like it's your money, but it's really not. It's important to realize that, and for many people, that alone is an epiphany. We think it's important to essentially get a divorce from Uncle Sam as soon as you possibly can. Pay him off like a bad ex-wife and get him out of your life. And then you're able to move on in retirement more effectively. And there are tons of things that we can do. We probably can't go into them in depth because they're kind of complicated, so can't go into an in-depth in the show, but tons of things that we can do that will save business owners taxes and that will save retirees taxes. And I'm not talking about $1,000 here or there, Ralph. I'm talking about tens of thousands of dollars a year, hundreds of thousands of dollars per decade, and in some cases it gets up to $250,000 or $500,000 over your lifetime. That's money that stays in your family. You can use it to live on, and if you don't need it to live on, then your kids get it. But whatever, it's far better for you and your family to have that money instead of paying it off to the knuckleheads in Washington, D.C. and Jefferson City.
Okay, there you go. Well, the bad news is taxes can be a big expense in retirement. The good news of that, though, you do have some choices, some options to help lower your bill. Barry and I will talk about that and explain more about it next.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy. But with someone asking the right questions and helping you learn where you truly stand, it can become easier to work toward your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. Our current tax rates are set to expire in just a few short years. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow so you can enjoy your retirement today.
Welcome back into Watts on Wealth, the TV show. I'm Ralph Hipp along with J. Barry Watts. And did you know, friends, taxes might be your biggest expense in retirement? It catches a lot of retirees by surprise. But Barry, there are a lot of ways to possibly lower our tax bill. And let's talk about some of those tax-saving options.
Well, there are over 100 different tax strategies that we use for our clients, Ralph. And one of the most popular of those is what's called the Strategic Roth Integration, SRI. You see, at the WealthCare Corporation, we hate the IRS. Now, we love the people who work at the IRS. Don't misunderstand.
Okay.
Some of them are our friends. In fact, our CPA at WealthCare used to work for the IRS, so he knows all the inside secrets. But we hate the institution of the IRS so bad that we took the letters IRS and turned them backwards to SRI. That stands for a Strategic Roth Integration. And that's one of the first and easiest steps that we use for clients. You see, Ralph, if I'm right, taxes are going higher. Different authorities from the Congressional Budget Office to the Wharton School of Business say that in 10 years, tax rates are going to be somewhere in the 50% range for most of us. And it makes sense, if that's the case, then to voluntarily pay taxes today at lower rates while you're moving money from tax-deferred accounts to accounts where they will never be taxed again.
What about Roth IRAs, Barry? A big topic, and how big a tax impact saving in a Roth might have versus saving in a 401k or traditional IRA?
Well, we do find that many clients choosing to pay their taxes today at the lower rates today are able to save 6 figures in income taxes.
How about that?
It's not unusual for the amount to come to a quarter or even as much as $500,000 over their lifetime. And that's a lot more than most people would have ever dreamed. Most people don't even realize they're going to pay that much tax in their lifetime. That's why when you tell them their number one expense in retirement is taxes, they don't know it. And that's the first thing you have to be aware of, because you can't fix the problem until you know you have a problem.
Right. Another huge topic, RMDs, Barry, those required minimum distributions, and how do those affect how much we pay in taxes?
Well, required minimum distributions, or RMDs as we call them, have a tremendous impact on taxes. You know what RMDs are, Ralph. That's when you lose control of your IRA and the government forces you to take the money out of the account in the amount that they say, when they say you have to do it, and pay taxes on it at the rate that they say. Now, if you were born in the 1950s, like you were, Ralph,
Yes.
required minimum distributions begin at age 73. If you were born in 1960 or later, as I was, RMDs won't begin until you're age 75. So right now, for either of us or our peers who perhaps are watching the show today, before you reach required minimum distribution age, you're in control. You can decide whether or not to take money from your IRA right now, and you can decide whether or not to pay taxes now and how much in tax you want to pay. Now, at today's lower tax rates than the rates which are to come, if you've got a good tax strategist, they can manage to keep you in low rates now, get the taxes out of the way, so you'll stay in lower rates later when taxes get higher. Realize this, Ralph, when you get to required minimum distribution age, the government tells you to move over. You're no longer in the driver's seat, they are. And they, the IRS, dictate when you must take income from your IRAs, the amount that you must take from your IRAs, and they control the rate of tax that you must pay, which incidentally is going up in January of 2026. That's when the first tax jump will happen. It's just one of many to come, but that first jump is going to cause most people to see their taxes go up by something like 15%.
Well, Barry and I on the radio show and Barry at the office will remind you when 2026 is going to roll around.
We told you so.
And make those changes, right. If your current financial advisor doesn't offer a forward-looking, tax-efficient plan for retirement, Barry, how important is it to maybe get in touch with you for a second opinion on this?
It's absolutely critical. Most people are taking their retirement advice from investment salespeople. People who, when you ask them about taxes, will say, well, I don't know, you have to ask your CPA. And at the Wealth Care Corporation, we don't do that to our clients. Our clients are sitting across the table from a tax strategist like me, and often there is in the room a CPA who used to work for the IRS. So he knows all the IRS's dirty tricks, and in the corner office about 15 feet away is where he always sits. So we're ready to help our clients with tax questions. We routinely build strategic tax plans for a retiree and save them over 6 figures in income taxes over their lifetime. We had some clients call just this week who are selling their business for a surprising amount of money, Ralph, $100 million.
Wait,
yeah, it's a lot of money.
They're selling it for
They're selling their business for $100 million.
Yeah.
And we're going to be able to erase almost all of the income taxes that they have to pay. We'll certainly bring them down to less than $100,000, but you've got to know the tax law in order to be able to do that.
Were they aware of that before you mentioned it to them?
Well, they know that that's the stuff we do. They came to us with the problem. They knew we had the solution, but they didn't know what the solution would be and had no idea it would be that good.
Thanks a lot, Barry, and great to hear all that terrific advice. Straight ahead on our TV show, Barry will explain why overconfidence can sometimes cause trouble in our retirement. How to plan for hidden risks is the next part we have in Steps to Confidence. Still to come on What's on Wealth, Barry will open up our mailbag to the Wealth Care Corporation and answer some of your questions from all over the Ozarks. Stay with us. We'll be back right after this.
Planning for retirement can be complicated. Helping create income that lasts, making sure your health care is covered, investing while managing risk, and don't forget about taxes. If you're overwhelmed, you're not alone. The good news is we have what you need to give you confidence to start planning for your ideal retirement, all in one convenient resource. You'll get answers to some of your biggest retirement questions in this easy-to-understand, practical resource. And best of all, there's no cost to you. Take the first step toward a confident retirement and get yours today.
Sometimes the biggest risks we take in life are hard to see. How do you navigate successfully into retirement? Barry explains in this week's Steps to Confidence. Barry?
Thank you, Ralph. In order to retire successfully and stay retired, one of the things you must do is be aware of and avoid icebergs that can otherwise sink your retirement ship. Now, if you've ever been to Branson, to the Titanic Museum, you know how easy it is to be sailing along on smooth water, only to have something hidden in the water tear a hole in your ship. In this case, your retirement ship, and that would be an iceberg. By the way, I highly recommend the Titanic Museum is a good place for you to take the family. One of the interesting things that happens there is when you go into the museum, they actually give you a little card with a name on it that tells you who you are as a passenger on that ship. And after you go all the way through the museum, then you get to find out whether your passenger lived or died. Now, at the WealthCare Corporation, we want to be sure that all of the passengers on our retirement ship live all the way to age 100 if possible, and that their income lives long enough to support them throughout their entire retirement. Always remember that icebergs are about 90% under the water and only about 10% above the water. So there are a lot of things that you may not have thought about that can affect you in retirement, and you need somebody to call that to your attention and protect you from the things that are hidden and silent, but in the dark of night that can tear a hole in your retirement ship. Now, we've already talked about what some of those things are. One of them, for example, is taxes. But what people don't know is that there is more than one tax iceberg. Of course, you may have to pay income taxes, but also realize that you could face additional taxes, for example, tax on your Social Security. Now, when it first started, there were no taxes on Social Security. But over time, the ever-greedy federal government has started taking bites out of Social Security by taxing up to 85% of it. And required minimum distributions from your IRA can force you to pay taxes on your Social Security. Now, another iceberg is your ugly Aunt Irma. That's the income-related monthly adjustment amount. That's government speak for the amount that you have to pay for Medicare once you're age 65. Some people think that Medicare is free. Oh no! When you turn 65, every month you start paying for your health care through Medicare. And the more your income is, the higher your IRMA payment will be. And so if you don't manage your IRAs to minimize your taxes, you will find that the money coming out of your IRA will cause the amount that you pay in tax on Social Security and the amount that you pay to ugly Aunt Irma to be much higher. In fact, some couples pay as much as $13,000 per year for their government health care, all because they didn't manage taxes back when they were manageable. One of the other things that you run into in retirement that can be an iceberg is the cost of health care. That's long-term care. And many people have not dealt with that and given any thought to how they're going to pay for long-term care. I find a lot of people who come and sit in my conference room really have just crossed their fingers and are hoping for their best, which I suppose is to die in your sleep. And that is the way to do it, by the way, but you don't get to decide if that's how it's going to go down. So you have to have a plan for how you're going to pay for health care. Now, I know a lot of guys that I talk to about this, they kind of rear back in their chair and they punch their wife with their elbow and they say, the little woman here, she's my long-term care plan. And that might be a good idea, but I just want to ask you, can she really pick you up and put you in bed and reposition your body and get you to the shower and all the things that are necessary in a day's time? I'm going to guess in most cases, the answer is no. I know in my case, I'm a fairly robust fella, and my wife is a fairly small and dainty thing. And while she's a registered nurse and knows how to deal with old guys, she doesn't have the muscle power to move me around. And so in our case, we built a retirement income long-term care plan, just like the ones we do for our clients. I built that for myself. And when I showed it to my wife, what she said is, you know, this will allow me the money to pay for the muscle to move you so I can direct the care, but someone else will be the one who lifts you up and places you where you need to be. Now, I'm hoping that never happens. I'm hoping to die in my sleep one night and wake up even in a much better place. But in case that doesn't happen, we have a plan for how to deal with it. So these are just some of the icebergs that can be in the retirement water. And I want to be sure that you avoid those icebergs to the greatest way possible. And an important way to do that is to think about adding these issues to your retirement planning. Back to you, Ralph.
Well, up next, have any questions about your retirement? Barry has some answers, so stay tuned.
How does your future look in retirement? When you don't have a strategy, the future might look a little fuzzy. But with someone asking the right questions and helping you learn where you truly stand, it can become easier to work toward your goals. You need a plan to help generate income that will last as long as you need it. And the first step to creating an income plan is an analysis of where you are now. Let us help you bring your retirement into focus with your free income analysis today.
When it comes to planning for the future, time may not always be on your side. Think about your taxes. Tax rates are historically low right now, but they'll likely be higher in the future. Our current tax rates are set to expire in just a few short years. With the right planning and strategy, you might be able to cut your tax bill in the years to come. But don't wait until it's too late to take advantage of today's lower tax rates. Let us be your partner in planning for tomorrow so you can enjoy your retirement today.
Well, one of our favorite parts of the What's on Wealth TV show. Time now to open up that mailbag and answer some of your questions about retirement. So, Barry, you're all ready?
I'm ready.
All right, let's go to this question from Marisol in Lebanon, Missouri. I know I have to be mindful of taking my RMDs at 73. We just discussed that a few minutes ago. And she's asking, what retirement accounts are subject to RMD rules? Can you go into more detail on that?
Yeah, I'd be happy to help you understand that. Thank you for the question, Marisol. And what a lovely name. Marisol.
Yeah, it rhymes with parasol.
It kind of does.
Yeah,
That's a really nice name. So here's the deal, Marisol. If you have an account that you avoided paying taxes on back when you were working and contributing, so that could be like a 401k or a 403b. If you were a teacher or nurse or worked for a nonprofit, you probably had a 403b, or maybe even some type of deferred comp plan. There are some of those for government employees as well. Anything that you didn't pay taxes on, you got a tax break when you were contributing to it. Then when you reach age 73, if you're born in the 50s, or age 75 if you're born in the 60s, then you must begin making RMDs, required minimum distributions. Now, there's a complicated formula that determines the amount you must pay and how you must pay it and what accounts you must pay it out of, whether or not it's in IRAs or 401ks. But essentially what it does is this calculates out to a little bit less than 4% of your account value in your first year. So if you'll just think about it for a moment, if you only withdraw 4%, but your account earned 6% or even 8%, even though the government wants you to be spending that account down and paying the taxes, your account is actually growing faster then you're taking money out of it. So it's possible to die at age 100 with an account that is actually much larger than you had when you started making required minimum distributions out of it back in your early 70s. Now, Marisol, there's something I have to warn you about. This is really important that you pay attention to. If you should forget to take the withdrawal on your retirement account, well, then the government has a punishment for you in the form of a penalty. And that penalty is 25% of the amount you were supposed to take out on top of the taxes that were due. So let's just say that Marisol has $10,000 that she needs to take in required minimum distribution. And let's say she's in the current top tax bracket, which is 37%. Well, then on top of the 37%, she's going to have to send 5% to Jefferson City. So that's 42%. So on $10,000, 37% and 5% is 42%. That's $4,200 in taxes she's going to have to pay, plus the federal penalty of 25%, that's $2,500. So the total tax that Marisol has to pay is actually $6,700 on a $10,000 distribution for an effective tax rate of 67%. So the message to Marisol and anybody who's of required minimum distribution age is don't mess this up. Be sure you make your distribution when you're required to do so. And at the WealthCare Corporation, we help our clients to be sure that they're making their distributions timely so they don't have to worry about it.
And getting rid of those mistakes can really save you some big dollars. Question number 2 comes in from Conway and from Dale. My wife and I have certainly noticed the big jump in prices lately. They're up around 3% right now. We have some goals to maybe remodel our kitchen, put in a pool when we retire. Now we're worried about what prices will be when our retirement actually gets here. Do you have a rule of thumb to figure that out so we'll know if we can afford it?
Oh, Ralph, you said prices are up 3% right now, and that's true year over year. But if we were recording this last year, prices then were up about 8 or 9%. So the point is, you add those years up, and every year that 3% or 8% or whatever it is adds to, and in just a few years, it gets really expensive. So I don't have a rule of thumb for Dale. Because rules of thumb don't work in this case. This instead is a case where a formalized retirement income plan really comes in handy. And here's how that works. You tell me your desired income number in today's dollars. We call that sitting on the porch money.
Yes.
And we'll take your number and adjust it for inflation from now till the time you're 100 years old, so we can project what your yearly income needs to be every year between now and the time you're 100. And that way you'll know how much money you're going to need to take out of your account. Then what we do is we take your sources of guaranteed income like Social Security and pensions, and we subtract those from your sitting on the porch number. And what's left is the amount of money that you have to take out of your retirement savings in order to hit your income number. And so now we can take that amount and we can calculate against it, charging it into your investment accounts, and figure out, are you going to have enough money to get to age 100 or not? Or we can tell you when you're going to be able to run out of money. I remember a client recently said to me, he was kind of mad about it, I don't want you to calculate it to 100. I only want you to go to 90. Okay, that's fine. We did his calculation to 90, but what happens if he lives to 92? So what we want to be sure of is that you don't run out of money before you run out of lifetime. So I would say to people, if you don't have a retirement income plan, then they need to reach out to us at the Wealth Care Corporation using the information on the bottom of the screen. And we'll help them to figure out whether they've got enough income to not only pay all their bills in retirement, Dale, but to figure out whether you can remodel the kitchen and install that swimming pool for the grandkids.
There you go. Talk about your lifestyle changes in retirement. Now on to Vince in Fairgrove, Missouri. Vince says, I'm 54, Barry, and my employer just offered a Roth 401k option. I'll probably work another 10 to 12 years. Is it worth switching to that from a traditional 401k?
Is it worth switching from a traditional 401k IRA to a Roth 401k IRA?
Yeah.
Only on days that end in Y. Absolutely.
Every day of the week.
It's absolutely the right thing to do, and you shouldn't miss that opportunity. I'm so glad, Vince, that your employer is offering this to you. And so the only way this might not be a good idea is if you were going to be in a lower tax bracket in retirement. But if you're like most of us, since taxes are likely to increase, then the Roth is going to be a great option to get the taxes paid and out of the way now, and then grow your money tax-free and distribute it tax-free in retirement. 0% taxes is what we're aiming for. And if we can hit it, great. For about a third of our clients, we do hit it. But for the 2/3 where we can't hit it, let's get you to the lowest tax bracket possible.
Sure. Barry, thanks a lot. Great advice as always on our show.
Happy to be here.
And happy that you were here with us too. If you want to know how to generate lifetime income, reduce that big tax bill, could be lower, and maintain the lifestyle you want in retirement, reach out to Barry now to start planning for your ideal retirement. For Barry Watts and the whole team at the Wealth Care Corporation of Springfield, this is Ralph Hipp, and Barry and I are wishing you a healthy and happy journey to and through retirement.